Hey everyone, my name's Andy. I'm from Finding Value Finance. I've got Danny with us from CapitalCOSM. He's got his own YouTube channel. He covers a lot of commodities, uranium, all that stuff. I wanted to bring him on, talk to him. We're in a very similar situation. Wanted to see how he sifts through all the information and talking to a lot of these insiders, how he kind of navigates the markets. So Danny, thanks for coming on. Really appreciate it.
Yeah, thanks for having me on, Andy. It's a real honor to be interviewed by you. You're one of the main reasons why I actually started a channel over the last year or so. So very happy to be here.
Yeah, good, good. Thanks for coming on. So can you tell us a little bit about your background, about the channel that you've got, maybe some of the sectors that you cover?
Yeah, so as I kind of alluded to, I started the channel about a year ago. I do have a W-2 job. I've been doing that for about 10, 11, 12 years now. And really got into investing around 2020, I want to say, during COVID. There's obviously we had that big crash in March, and I just felt it. We were all locked down, and I just felt it incumbent to finally make a move. I had saved up all this money for my W-2 job. I lived with my parents all the way up until I was 29, so I had a lot of cash saved up. And for all Zoomers out there, or like 20-year-olds, younger folks out there, there's nothing wrong with living with your parents, especially if you can you take away that rental expense. That'll give you some capital play when you want to get married, start a family, etc. But anywho, we came into 2020. I had all this cash that I accrued over almost a decade then. And that's when I started really looking into what I should deploy my capital into. And I discovered the likes of, that's when I found George Gammon, I found Chris McIntosh. I had already listened to people like Peter Schiff and Harry Dent before. That's kind of like your gateway into our space, I'd say. The very mainstream alt finance media. So I was already aware of like gold. Gold is money, precious metals, etc. But being introduced to commodities, that didn't really happen until I want to say like February or March. That's when I discovered all these different YouTube channels. I think I discovered you in 2021, I want to say. And yeah, I just became a madman. I just became obsessed with this stuff. I just started consuming so much content, like subscribing to newsletters, watching YouTube videos, for like 8 hours a day, when I wasn't working. And I became so interested in it. I started really wanting to kind of put some of the stuff that I learned out there, and also meet some of the people that I had been watching online as well. So I think in 2022, I made my first video, and it wasn't that great. I mean, you guys can go to my channel and you can see some of those first videos I made. They're very raw, rough around the edges. And then 2021, like I said, I started listening to your channel. I started seeing some of the the patterns that you taught us in terms of technical analysis. My background is in math and statistics, by the way. So a lot of the stuff that I read, I watched on technical analysis, on the principles of investing, came very easy to me. I'm a very quantitative person by trade. I have a bachelor's in math, I have a master's in statistics. So a lot of these disciplines, there wasn't much friction. Usually when I heard it, I just got it instantly. And so I started my channel, I want to say December of 2022, or no, I started my channel before then, but then I started really upping up my game. I bought a better webcam. I started posting more consistently, and then things started slowly. I mean, I haven't really taken off. I haven't fully taken off yet, but it has started to accelerate, and really started enjoying the interview portions of the channel as well. I do live streams, I do interviews, and the cool thing about the interviews is, they say you never meet your heroes, but a lot of the folks that I interview are the same on camera as they are off camera. Like,
Gotcha.
I was actually pretty shocked to see that. Like, you, Andy, you're what you are on camera versus what you are off camera. So are a bunch of other people that I've talked to. And so there really is a deep-seated passion with these experts that I've come to realize. And it's not an act, as far as I can tell. I mean, I don't know, but as far as I can tell, I've met with a lot of these guys on multiple occasions, and I can really tell this is what they truly enjoy. And I've just been consuming all YouTube videos, content of all sorts, newsletters, etc. And that's what got me to this point. So I'm really kind of still a newbie when it comes to commodity investing. I'm not like a veteran like you are, but I've tried to make up for it on just volume, just brute force, just consumption of information.
This leads me into the other question. You've got your channel, you've been looking at commodities, you're consuming stuff, you're talking to, I've seen you got Jim Rogers, Rick Rule, Chris McIntosh, you got all these guys, and you're talking to them behind the scenes, behind these interviews. How has that changed your perspective on the commodity sector? How has that changed your view on the sectors? What have you learned? How do you navigate through the different opinions of all these quote experts? How do you navigate? Because I know a lot of people, they go on YouTube, they consume content nonstop, all these guys giving all these different opinions. How do you handle that? And how do you sift through it yourself?
Yeah. I mean, that's a very great, good point. Good point there. I do notice that with our audience is that they are very consumption heavy, which is good. But at the same time, it can lead to a bit of analysis paralysis. So what do I mean by that? Well, you consume content from this side that tells you that the economy is just fine. The commodity economy is going to soar, for example. And then, for example, you consume content on the other side. Oh, the economy is about to crash. We're about to have, like, I think you alluded to this in our pre-interview talk, 80%, et cetera. And you have these people consuming everything so much that you lose the signal from the noise. You can't discern what's noise and what's signal, because honestly, I mean, no one's ever 100% correct. No one's ever 100% wrong. You've got to have the discernment, the judgment to pick out the nuggets from each individual person's analysis and be able to kind of create your own model. You've got to look at the raw data as as raw as it can be, but you have to really put in the work into understanding the foundational data, and then you can kind of listen to this person, listen to that person, and kind of take a little bits and pieces from each person, come up with your own model for the investing world. And so I wouldn't say that I'm not one of those people that doesn't consume all this content, but I'd say I'm probably 50th percentile across our audience. There's people that I've seen on Twitter, on my comment section, that are just like, wow, I mean, you guys, this is like a full-time job for you. It's more power to you. But just realize that it's sometimes less is more. Sometimes you've got to really, really fine-tune who you find credible, and just hone in on that discipline. So a lot of the times what I'll see, another thing, is that people will change their strategies constantly. They might change their allocation strategies, and they might change their exit strategies. There's a saying that you've got to be nimble and so forth, but at the same time, if you're constantly changing throughout the course of the game, then it's going to be really hard for you to actually, because think of it this way. I've always thought of my portfolio as a bar of soap. The more you touch it, the smaller it gets. And there's actually studies on this. There's a study called the Fidelity Study. And the upshot of it was they compared all these different portfolio strategies. And I mean, it looks like the result of the study. Can you guess which portfolio strategy ended up?
Yeah. The ones winning? That were dead outperformed all the ones that
Bingo.
were alive.
Yeah, bingo. So sometimes you've just got to commit to a strategy and just stick to it. Don't go jumping around all over the place. Don't don't let your emotions lead the way. You have to have the conviction, which I think a lot of you guys do have. You're consuming a lot of content, but you can't. There's a difference between being well researched and having conviction. You can read disparate pieces of content and just be scatterbrained. Like you just don't know what the signal is. So that's why it's important. What you do, for example, you look at the raw data. You don't just listen to people's opinions. You actually open up the hood, and you start tinkering with the vehicle itself. The vehicle, being the economic data, the company data, sector data, etc. So yeah, I mean, I think the upshot of it is you've just got to be a very good discerner of signal, and don't get too scatterbrained with this stuff.
What strategies do you deploy when you look? I mean, are you kind of just in for the next decade, 5 years, something like that? Or are you trying to time stuff on a shorter term horizon?
No, I'm usually so anytime I get into, like, for commodities, for example, I understand that these cycles take quite a bit to actually mature. So getting into these commodities back in 2020, I signed up with Capitalist Exploits. It's Chris McIntosh's newsletter. That was the first newsletter that I signed up to, and he taught me a lot in terms of like investment discipline and investment strategy. For example, one of the things that they teach is that you don't allocate more than 2% on a position, more than 10% within a sector. That's a good introductory step for like newbie investors, so you don't lose your shirt in the process. Effectively, what it does is gives you a psychological edge in that, if you lose 100% on one position, it's not the end of the world. You're still going to be able to sleep at night. A lot of people that I see, especially like in the uranium space, for example, that are just like 100% allocated to uranium. And so they become hyper obsessed, hyper focused, in a way, kind of like, I don't know, aggressive in a way. And I think that's obviously because you've committed so much capital on the table, and you've spent so much time and dedicated so much time to it, which you should, by the way. I had Jim Rogers on the show several weeks ago, and I asked him, how what I asked him the same question you did. What's your strategy? And he basically said, if you want to make money, you have to invest in one thing, but you better study that one thing deeply. You better know it like the back of your hand. And unfortunately, most people are not going to be Jim Rogers. So, I was kind of I didn't feel good letting that message out to the audience, just because most people aren't capable of just buying one thing and nailing it like Jim Rogers. There's only one Jim Rogers, and like the folks that he hangs around with, they're like the 1% of the 1% of the 1%. Okay, that's people watching this show. That's probably not going to be you. I mean, statistically speaking, that's probably not going to be you. So you're probably better off. I mean, I am too, by the way. I'm not like investing in one thing. I'm invested in uranium. I'm invested in nat gas, coal, oil, gold, silver, copper. A variety of different commodities, and a few other non-commodities as well. But it's not like I don't have so much riding on one thing being right, so that I'm always kind of like, for lack of a better term, on edge.
For Jim Rogers, in order to do that, you better be emotionally like
Yeah,
stable as you can be. Because if you've got a gigantic position riding in a certain sector or something like that, you better not only have conviction, but you better have nerves of steel, because you're going to get some volatility depending on what sector you're in, and your whole portfolio's going up and down like this, quite massively.
yeah. And I think
So
Buffett said something along the same lines. He said you only need one or two stocks. I can't remember the exact quote, but he said something along the same lines. But most people, you're not going to be Buffett. You're not going to be Jim Rogers. Okay, like those people are just so far and few in between.
concentration can build wealth the fastest, but it can also destroy you very quickly
Yeah,
if you don't know what you're doing, because you're going to go down and then you're going to get scared and you'll sell out, and then you get a big huge loss, and then you can't make it back up depending on the sector's volatility. Because if something like, if uranium, it goes up and down so easily, you get cut in half in 2 seconds, but then you need to double to get it back. And uranium can double quite quickly, but other sectors, it may take many years to get back.
Yeah.
double.
Yeah, I mean, people always
So
talk about like what's your edge in investing, et cetera. One of my edges is that psychologically, I can go to bed at night without having to overthink this stuff. Sometimes, um, I I kind of still hold that capitalist exploits discipline that they've taught me. No more than 10% of the sector. I've kind of expanded it a little bit above that. The more I learn about, the more comfortable I feel about certain sectors. I kind of break the rules there a little bit, but I don't get too carried away with it. But that is an edge that you can have as an investor, is that you can create an edge by your position size. So you're not like on edge. You're not. You have that ability to hold through volatility if you have to. And also, most people. How do I want to say this? But most people just look at this stuff as like a casino at times. They're just trying to score, to like trade this thing for this thing, and be swing traders. But that's not where the money is made. I mean, like I alluded to before, the more you touch your portfolio, and this is done with this has been found out by scientific studies, etc., you're more likely to lose money. So sometimes, again, more is less. Don't overthink this stuff too much. Identify the opportunity. Identify, like George Soros says, where the premise is. Find a premise that is wrong and then bet against it. If you've done enough research, then stick tight and hold tight and be right. And you've just got to pursue the volatility. Volatility is the price that you pay for your big gains.
So you're adopting a hold strategy, buy and hold strategy through the commodity bull market. What are you using for potential sell signals at the end of this thing? What kind of have you come up with?
Yeah. So, ratios, of course, it's not just, I'm not just pricing different sectors or companies just in dollars. I also look at them priced in things like gold, the CPI, the M2 money supply, the overall market, like the S&P, things of that nature. And if you're starting to see like topping patterns in the charts, for example, or if I really start to notice a lot of euphoria. I mean, take, for example, again, uranium in 2021, remember like all the euphoria that we had back then. We even had posts on like Wall Street Bets, like 2 or 3 posts a day on Wall Street Bets, like those guys. I don't think many people still talk about those guys. I don't know what happened to them. I think they're still around, but compare where we were like in the uranium market. Like if you take the major ETFs like URNM, URA, I mean, heck, even the actual uranium price. So uranium back then at that 2021 euphoria level, uranium was sitting at around $60 at that peak. Today it's at $104. And you compare the euphoria level back then versus to what it is today, and it's no comparison. I mean, there was way more euphoria back in those days than there is today. And I actually have a good chart for your audience to look at to kind of explain why that is. If you want me to share my screen, I can do that.
Let's bring it up. Let's bring it up.
So this is a really nice chart I like to show off. So this is, here we go. So these are, so this is URA, and you've basically got the URA price denoted by this black line, but then these green bars denote institutional ownership of URA. And so the upshot of this chart is that when URA was consolidating down here, institutional ownership from like family offices, hedge funds, et cetera, was ever so increasing. So this is basically telling me that retail was selling off and institutions were buying. For lack of a better term, this is what you'd call the smart money. I showed Rick Rule this chart, and he laughed when I called it smart money, because he rubbed shoulders with a lot of these guys, and he told me that they are far from smart. But that's neither here nor there. But you can clearly see the euphoria that you saw in 2021. That was retail euphoria. Now we've either hit that same URA price or about to break, or actually a little bit above it, but yet institution, we don't have that same euphoria because it's all been driven up. This move, and it seems like this move in the uranium sector has been driven up on the backs of institutions, as you can tell here. As this stuff, as the price came down, they just kept buying more and more. And I remember when I first started my channel, actually, I started really posting videos consistently in December of 2022. And I started posting about uranium. And I had so many like comments in my comment section. They were like, oh, like this guy is so late on the trade. Uranium is covering a dead trade. And in my mind, I was like, hold on. This is a really good indicator. This is telling me that this is the time to get into uranium. This is like the best time to start looking back into uranium, because like sentiment was shot. I would post on like I would record my videos, and then I'd go to like Uranium Squeeze on Reddit, and I'd post my videos on there just for added exposure. And I'd also post it on like places like Wall Street Silver, a couple other forums. That's a hack, by the way, for like you up and coming YouTubers. One easy way to get exposure for your videos, just go to all these forums, post them on various forums online. But I noticed that whenever I posted videos on like Wall Street Silver, Wall Street Bets, they were always received with, people actually liked them. They're always positively received. But when I posted the same videos on the Uranium Squeeze Reddit, I had so much hate. Like this guy is so late. Like this guy is like, I had way more vitriol from the Uranium Squeeze guys than I had from like the generalist investor types. And that just told me like there's just so much animosity and bad feelings with uranium investors at the time. So I could tell that they were being squeezed out of the play. And so, as time went on, of course, I think we bottomed out around March of last year, and we started breaking through at second half of 2023 is when we broke out of that consolidation pattern that we saw in the ETFs. So, kind of answer your question. I look at sentiment online. I tend to always go. It's kind of in my nature to go against the herd. I don't like following sheep. I don't like following like a crowd. I don't like following movements. I've always kind of been like a black sheep, so to speak. I just don't. I don't like just blindly outsourcing my decision making to a group of people. So I've always had this ability to kind of find out what's really topped out in popularity, not just in markets, but like in general. And I've been able to translate that into my investment practice. So really being able to like on an intuitive level sense when there's too much euphoria, too much positive sentiment within a sector investment, etc. But at the same time, I also look at the charts. The ratios tell a big story, because most people don't even look at ratios. Like these chart analysts, they just look at things priced in dollars. Like, what good does that do you? Like, especially if you have to look at this stuff on a long-term basis. With like uranium, like I try to look at this stuff as far back as possible. With any chart, I try to pull it back as far as possible. You go to max, et cetera, on trading view display, you just pull this back all the way back and see if you can identify patterns in previous bull markets that are matching up with what you're seeing today.
Oh, you're going with fractals. I like it.
Yeah. Learn from the best.
That's good. So what sector do you like the most right now, and why?
It's a good question. I see a lot of great news coming into the uranium side. A lot of great news. And when this thing runs, it really runs. With the sole exception of maybe crypto, gold, oil, gas, none of these other commodity sectors run as fast as uranium does. It's often called the rock star of the commodities. But if I was to say, let me put on my contrarian hat and try to think of what's probably the most hated or most undervalued sector at the moment, I'd probably have to say probably the gold miners. Because I try to like take in how I feel about something and try to invert it. And I don't want to invest anything into gold miners right now. So that probably means I probably should. I think that's an exercise a lot of people should probably try. Also, another thing is probably base metals like nickel and lithium. Those things have been in the dirt as well. I'm trying to pin it down to one. I was just looking at a coal chart actually. It looks like coal's actually been basing out in recent weeks. So, coal came down what 80, 90% from its highs in 2022. So coal might be a good opportunity. But right now, I think like very near term, definitely uranium. Near term uranium,
Yeah,
maybe
uranium's
long
got the
term.
momentum.
Yeah,
Yeah.
it's got momentum. And to a lesser degree, over let's say within a 1 year time horizon, probably Bitcoin or the crypto complex as a whole. It's just purely based off of it too has momentum, but it's coming off of this ETF approval, as well as coming into the its 4 year halving cycle, which always precipitates a bull market after it. So, but near term,
Here's another question for you. Allocation to these sectors. I know some people, they always ask me, what's your allocation strategy? How do you allocate to this sector versus this sector versus this sector? What's your opinions around allocating to these different sectors? And why do you allocate certain sizes to certain sectors?
Yeah, so I do have rules for me to not over allocate too much. So for me, it's I in regards to my cost basis, I try not to have more than a 20% weighting in one sector. Now the sector might supersede that, like uranium has. I made a conscious effort not to, when I first got into uranium, for example, made a conscious effort not to over allocate more than 20% of my portfolio cost basis on uranium. But ever since then, it's become more than 20% of my holdings. So that's kind of a rule that I followed there, just to not, again, have that psychological edge, have that I consider it diversification. Some might consider 20% a little too weak. Some might consider it a little too aggressive. I think it's a good sweet spot, not to go over 20% on a sector, 5% on a given holding, et cetera. But I've got 10 or 11 uranium. But my general rule between allocating between sectors, I like to look at ratios between the two sectors. So, for example, if I'm trying to decide between putting more money in uranium companies or oil services companies, I'll pull up a chart of like uranium. I'll pull up a chart like URA versus OIH or something. And the charts can typically tell you if we can look at it right now if you want.
Yeah, bring it up. Let's do it.
Yeah, let's see.
And if you show us what you look at from a long-term view, it's probably very similar to how I do it too.
Yeah, so this is
look at that.
Look at URNM. Look at that big.
Hey, that's a big middle finger there.
Wow. I think that's bigger than that's the biggest green candlestick we've ever had. Yeah.
Yep. It's breaking out of, well, that's good because it's breaking out of an all-time high. That's what you want to see, is a big green
there it is.
candlestick.
Right there.
Yep.
So so for example, you can look at, you're trying to decide between uranium and oil.
Yeah, you forgot the little exclamation mark after it.
Yeah. So uranium is pretty move that out here. Yeah, uranium is outpacing oil by a significant. I mean, no surprise there. Why is do the audio?
Yeah, uranium's outpacing everything, absolutely everything right now.
And so this was the high in 20. Where's the high in? So this is the high in 2021. If I zoom in.
Yeah, that's when oil went negative in roughly that time frame in 2020.
Yeah, but I'm talking about 2021. So this is the uranium high, the uranium spike in 2021 compared to oil.
Yep.
Right. This is when spot came on the market and just started gobbling a bunch of uranium off the spot market. And that's another interesting thing about this rise here, is that this entire move was mainly due to spot, just gobbling up pounds from the market. Now, this entire move here had nothing to do with spot. Spot was barely a blip on the radar throughout this entire time period. And now all of a sudden, spot is at the market again. So I mean, you're adding fuel to the fire, no pun intended. So this thing can get really wild. But oil looks cheap against uranium, but in terms of most people don't invest in oil futures. So to kind of make this thing practical, you've got to look at something like URA divided by, if you're in the oil services companies, you'd look at OIH, for example. And this is URA price in OIH. And what you can basically see is that URA has been underperforming OIH. So the uranium miners have been getting decimated against oil service companies for a couple years, from the November 2021 uranium spike all the way out until summer of last year. And we recently broke out of that. So uranium miners are breaking out against OIH. So if I were to say, I have a choice between URA or uranium stocks or oil services stocks at the moment, I'd say uranium stocks definitely have the momentum behind them. I wouldn't really think about I wouldn't really think about the opposite until I was around this level here. Maybe another 50% move or so in the uranium ETF price or something along that line. Holding the oil services constant, which obviously they won't be constant, but this is the kind of stuff that you have to look at. Ideally, this would be the time to sell oil services companies and buy uranium companies, but that's not the way I roll. I usually just add more. I'm usually just more on the buy side than the sell side. So when I see something like this, I'm not going to sell my oil services companies. I'm just going to buy them. But with extra capital, if I had to choose, I'm just going to choose the uranium miners as opposed to the oil service companies. And once you rip a little higher, that's probably the time to buy more oil service companies.
That's exactly what I do, to the T. When something's got a real good setup, I add new capital, fresh capital to it, boost the portfolio, boom, it goes, and then I add to something else when something else is way down. Totally agree.
So whenever, again, like I have extra capital, I just open up these charts. I go through all these different ratios. I pull up like URA versus GDX versus OIH, and that's what really drives my decision. Is that where can I find like ideally something like this at this level, like just right at the resistance line, about to break out. That's usually what I choose. This is
retest is good too.
Yep.
I
Ideally,
like that as
May
well.
2023 is when you should have bought uranium stocks over oil stocks. Ideally, what is it? November, fall of 2021 is when you should have bought. If you had a choice between the two, you should have bought oil stocks over uranium stocks. You could probably make a case that it's fair valued now between the two. It's really a coin flip, but I like the momentum behind uranium. So that kind of like gives it the little edge.
Yeah, you can also look for companies that are lagging and are down in the uranium sector, and those will probably follow suit soon, is my guess.
Yeah.
Like the juniors or something like that.
Yep. Because the way capital flow works with this stuff is, money's going to flow into the metal or into the resource, depending on what the commodity is. It's going to flow into the resource first, whether it be uranium spot, oil futures, gold, etc. And then after that, capital flows into the big caps, the major cap stocks within the sector, and then it flows into the mid caps and then the smaller caps. And here's another telltale sign of a bull market is that you want to start seeing your speculative names start to outperform your bigger cap names. And so when I'm looking at, like, again, back to uranium, let's look at URNM priced in the actual metal itself. In a bull market, again, bringing it back to that 2021 spike, we started seeing URNM outperform the metal itself by, it shot up 150% between November of 2020 to November of 2021. And that's a telltale sign of a bull market, because it means capital is more confident in that sector, that they're willing to go further out onto the risk curve. And so when the metal begins to outperform the equities is when you're most likely in a bear market. And so what's really looking nice here is that you essentially have URNM right on resistance. So URNM is about to break out against the metal itself, and the metal's been moving. I'm sure you guys have been keeping up with it. It went from $96 to $104 in a single $100 in a single day, and then it went from $100 to $104 in another day. So you're seeing 4 to 5% moves in the metal itself in one day. And so to outperform the metal, the ETF, the ETF has to move even more essentially. And it looks like that's what's about to kick off. What's really interesting is that we have had this huge move in the in uranium, even in the equities to a lesser degree, but the equities have definitely been underpacing the metal. But this thing is rarely, it hasn't even gotten started yet. Just look at it. We're just at the starting line. We're right at the resistance line. You can easily say, maybe this is your target. Can we get back to those equities to metals ratio of 2021? That would be what, a 2.5x move or something along that line. What is it?
Against the metal. Yep.
Yeah, against the metal. So just to get back to parity as to where we were in 2021, equities to metals ratio, you need a double. You need a doubling. Just holding everything constant, holding the uranium price constant at $104.
That's 2021 though, because in 2007 or even 2011, if you look at like URA, it's way up there. We're looking at it shorter term.
And you know what? Even that's an underestimation, because URA only goes back to 2011, right?
Yep.
So it doesn't have that.
You have to scoot. There you go. Yeah, it's way down there.
Look at that. So this is URA price in uranium. And again, this is 2011. You're not even taking into account 2007. So, just to get back to those pre-Fukushima highs, you need almost a 7x, a 7-bagger.
Yep.
So,
and that's on URA, because the little guys.
Yeah, and URA is 70%. Isn't even a pure uranium play, FYI.
Right.
Which, you guys already know that, but it's good to keep in mind there. So, number one, here's your thing. Number one, this is not even a pure uranium play. Number two, this only goes back to 2011. You're not capturing those 2007 rips. The metal was actually twice as expensive in 2007 as it was in 2011. So, the rough estimate, you probably just double. You could just say 7 times 2. You could be looking at a 14x effectively. A very rough around the edges, back of the napkin estimate. But yeah, the miners look as, and here's another thing. Let me pull something up else really quick. So I'm going to pull up the uranium market cap of all of these different companies. Okay, so this lists the biggest uranium companies by market cap. Total market cap at the moment is $65 billion. That's it. Even with like this huge move up in the equities price, we were at 2-year high. What is it? I want to say 15-year highs in the equities. We're not 50, maybe 10-year highs in the equities. And we're still at $65 billion market cap. At the height of 2007, the market cap of all these companies was $150 billion. So, and then that's not even taking into account all the inflation that happened between 2007 and today, the changes in supply and demand, the supply and demand deficit. There wasn't a deficit as there is today in supply and demand. It's mainly precipitated by the Cigar Lake flood. So, the game has changed. I know you're not supposed to say this time is different with investing, but if the shoe fits, I don't know what else to tell you. It is different this time around. I mean, what do you think?
I think that the chart setups in uranium look absolutely ridiculous.
Yeah.
The momentum that's being garnered in the physical spot price, and the question I have is, what's going to stop the move?
Yeah.
I
So
don't
like
know.
if I've got Cameco's market cap over time. We're actually at all-time highs in Cameco's market cap.
Mhm.
But I want to show you one thing is that if you look at M2 money supply over time, '07 is right around here. It's about $7 trillion in money supply in '07. Today it's at 20, just under 21 trillion. So you've had a tripling of the money supply between '07 and today. So here's one, oh, not this one. Here's one thing to keep in mind is that this $18 billion in CCJ market cap in 2007, you'd have to, that's equivalent to about $55 billion in today's money, taking into account the added money, added liquidity into the system. So even even if we're at $21 billion, I still think there's a long ways to go just to correct for, or just to control for the inflation.
The one thing that a lot of people bring up, they bring up market cap all the time. They're like, well, compare the market cap to the previous thing. What I'll say there is market cap is it's a piece of information. It doesn't tell you anything about value.
Right.
So a lot of these companies, the Bannerman in 2007 is not the Bannerman it is today. It's
Yeah.
completely different in terms of pounds in the ground, feasibility studies, all that stuff. So
Yeah. That's why
I
I
don't
love
think,
CCJ, by the way, because CCJ's,
yeah.
it's the closest that it's pretty much the constant in the uranium space.
Which I agree with. I'm just letting know because people
Yeah.
always ask me this. They're like, "Well, Bannerman's market cap in 2000." I'm like, guys, it's a totally different company. They didn't have 280 million pounds or 270 or whatever it is in the ground, proved up. They had like 20 million at best. And then you look at what they were priced at. They were priced at $20 per pound in the ground, and today it's like not even close to that. And you look at your market cap, $20 per pound times how much they have in the reserves, compare the market caps, and they're like, oh, there's no way it's going to go that high. It's like that's what it did last time. What makes you
Yeah.
think it's going to be different this time? And they're right at the front gate, of potentially producing at some point. So not trying to push Bannerman to anybody. I'm just using them as an example because I know the stats or the data on it.
Yeah. Bannerman had a good
So
night last night. I'm sure you know that.
yeah, yeah. There's some insane opportunities out there that in terms of movements, potential movements. What's your thoughts on the uranium sector and the companies? I mean, here I'll bring up an example. I just saw UEC there. It was like a 3 billion market cap that you had pulled up there. And next gen was like 4 point something billion. And usually when you are an investor, you invest in companies because of cash flow. But none of these companies have any cash flow. So would you consider these things to be really risky? Like what's your take on that? Because I mean, I can find companies that are 500 million, 700 million, and they're making 400 million in free cash flow. And I look at UEC with a 3 billion market cap with no cash flow, and I'm like,
Yeah.
do I
Yeah.
do I allocate to it? Should I go after the cash
Yeah.
flow?
Hey,
And
listen, I mean, we're not investing in Coca-Cola or Delta or anything of that nature with this stuff. I mean, at the end of the day, this is all speculation. This is why you've got to position size accordingly. You can't invest more than you can afford to lose. That old adage. So, I mean, I agree with you. It is risky, but that's why it's imperative to actually understand the thesis at a very deep level. So then, you understand what the risks are. You understand the potential upside as well. Everything is risk reward in life. Okay, so the perceived reward of getting this right is much riskier than I feel. I feel the biggest risk in this thing is selling out too early. because I'm just going to take you behind the curtains. I'm not going to tell you who it was, but one of the guests that I interviewed, he told me, off camera, that a lot of these hedge fund guys that he knows are like they're anticipating some really wild that no one's saying on Twitter, like not even triple digit moves. I'm not trying to be hyperbolic, but that's just what I've been told. So I didn't even like talking about this stuff just because it makes me sound kind of crazy. But I've heard
Join the
some
club.
wild projections off camera. That's all I'm going to say.
Well, yeah, yeah. So what are your projections of where you think uranium might go? Not to put you on the spot. I mean,
Yeah,
I'm free with sharing mine too. It doesn't matter to
yeah. I
me.
mean, like we looked at this on the channel a couple days ago. So I looked at if you price it in the CPI, that's probably your most conservative projection. It takes you around $200 uranium. Now, if you price this thing against a number of other different things like gold, like M2 money supply, even against the market, the S&P, all three of those ratios take you to around $400 to $450. So if I had to bet a dollar, and I've bet more than a dollar on this stuff, but gun to my head, had to bet a dollar, I'd say base case is around 200, and that's also in line with Thomas George. I interviewed him a couple days ago. We posted the interview yesterday. That's also what he thinks as well. 150, $200 is it's $200 is my base case. I'd be surprised we don't get it to 150, honestly. But I think it can go much higher than most people are anticipating. But I'm not willing to say that. I think high end is probably $400 for me. Just because anything beyond it is just unbelievable. I just can't wrap my head around it.
Yeah. So then my question then is, if you look at the conditions that uranium is subjected to, we had a surplus in the 1970s. In the 1970s, we went to a ratio of, I think it was like 1 to 4, 1 to 5 to gold. And if we're at 2000, that's $400 or $500, like you said. But we don't really have a surplus. So
Yeah.
it's kind of like, are we comparing the same market conditions of 2007, which was just a credit expansion phase, and same with 1970s?
Yeah.
But now, if people do panic and there's an actual shortage, like I don't know where it's going to go. Like
Yeah. I
400
mean,
is low.
I hate saying it, but the game has changed. Like I'm gonna say the taboo words. It is different this time around.
I don't know.
I mean, what
Hey,
do you?
I'm on record, right?
Yeah. Oops.
Uh-oh.
I, 20 lashings for CapitalCOSM. Trying to look up trying to pull up what is it? The supply demand chart.
What what companies are you looking at, like in terms of like the size of producers, developers,
Yeah.
explorers? Are you moving
So
down to the explorers?
I don't. So a big piece of my position is just the metal is spot, just because it's like it's almost guaranteed returns, right? Like the more you look at this
The
stuff, the
risk
more it seems
reward.
like the metal is going to rise. I mean, most likely, in my mind, it's a 95% probability, something like that. Um, that's about like if you take my uranium portfolio, that's probably the highest holding. And then I've got stuff like Next Gen. I've got stuff like Bannerman, Boss Energy, Paladin. So like a lot of mid caps. I'd say most of my stuff is mid caps, and then a huge, not a huge, but a significant spot holding.
You want to see something
I don't really
cool since you
mess
brought
around.
up
I don't really mess around with like the high end, like the high risk explorers, just because I don't have the time to like go like. I don't like studying individual companies. I like studying sectors. Like that's just me. I like I like studying sectors and macro, and then
Mhm.
just investing in like a diverse allocation of like mid caps to large cap stocks. I don't like messing around with like the high risk stuff. Then that means
Oh,
I have to like put down the hours and study this stuff and keep up with the CEOs. And some people enjoy it. It's not. I'm not wired for that stuff. I'm a macro guy.
I like playing the scratch off lottery tickets. I put some
Yeah.
money in them, but it ends up with a
But the
lot
thing
of
is, like,
positions.
I mean, this thing already has so much torque Like, do I really need more torque on top of the torque? You know what I mean?
I am, yes. I'm gonna do it.
Yeah.
But I only put teeny amounts in it.
Yeah, that's true.
That's all I do. Yeah, since you brought up Bannerman, check this out. Just a FYI for everybody. Here's your Bannerman futures pricing. That
Yeah.
looks so good. There's your bottoms here. You come up, you do a retest, and we're just ready to come on up and move on up for Bannerman. So that I think Bannerman looks good.
Yeah. What's the retracement there?
So you want to see the
Size?
how much it could potentially go up? I'm getting you
Yeah.
excited, aren't I?
Yeah.
So let's do, oops, wrong one. Green up to 9 or 10,
10x.
10x
Yeah.
against the uranium price. So if the uranium price doubles, it's going to be 10x that.
Well, I mean, this basically, so when you have things like Bannerman outperforming uranium to that degree, as you saw in 07, that's prima facie evidence that you're in a bull market, is when you have like a miner like that outperform the metal, because capital is flowing into a riskier asset as opposed. So that essentially tells you that capital prefers a riskier asset to the physical. So that says that the mind of the market is saying that we are confident in the fact that we are in a bull market. Now, you could have, that's assuming that uranium holds constant, by the way,
Right.
at $104.
If uranium goes 2 or 3x up,
Yeah.
that's 10x.
If uranium goes to $200, you just double, you're dealing with a 20x then. Uranium goes to $300. And if you need to go back to parity with that ratio, then you're looking at a 30x, et cetera.
No, it's more.
It's, yeah. I mean, I was texting one of my one of my normie friends the other night. Hope he's not watching this, but he was asking, because I told him to buy URNM at $35. It's at $60 today. So he's got a decent 60% return he's held it for about a year. So he essentially bought it at the very bottom of 2022. And he was asking me like what he should do, and I was like, what are your price targets on URNM? And I was just like, do I really want to tell this guy like 10 20x? And I just went like, by year end I could see it get around triple. I could see a tripling happen within a year. It's like, really? That's bold, dude. You don't even you have no idea. You have no idea. Like, I had to like temper it so much just to make it believable, or else like he would have just thought I was just making.
Well, here's another thing. How do you explain the situation to someone who doesn't know much about, say, uranium or a lot of these other commodity sectors? Because I run through the same thing. It's like it does nothing, nothing, nothing. Everybody gets impatient. They're like, "Oh, I want to sell this crap." And then it's like, guys, what's coming could be so big that they don't understand the symmetry in the setup. So it's like, no, no, no. Like, this isn't like a normal Pepsi stock. Like, these things can go,
Yeah.
they can make multi-decade returns in like a few years. Like, no one understands that. And it's like, how do you get someone to understand that gravity of it? If when this thing goes.
I just go with a simple explanation, really. Just show them that supply demand deficit over time, and just say, well, look, there's going to be all this demand moving forward into the future, and supply is continuing to dwindle down. Just the other day, Kazatomprom, announced these production cuts. So there's a lot of pressure on the supply side, and a lot of pressure on the upside with the on the demand side as well. So that's the way I kind of explain it, and I just kind of like to say, well, I mean, just put it in like a responsible position. Just have some sort of seat at the table, as Justin Hume likes to say. And they usually, my friend did, and now he's up 60% from last year. And he's like, oh, well, I'd be happy with another 60%. Like, dude, don't worry about it. Like, I think you're probably going to get your 60% gain in over the next year.
One of the things that was really hard to explain to a lot of people is, and this isn't about uranium, I'm just talking in general. When you're really, really early and you buy really cheap, the multiples that you get are like getting a 50x when people haven't gotten that return themselves, like it's not in front of them and they haven't realized it, it's really hard to explain what a 50x mean. It's just a number.
Yeah.
So, you know,
Yeah. I mean,
in order to get like a really in order to get a really big return, like a 10, 20, 30, 40, 50x, you got to be really, really early. And you can't rely on price as a justification to buy it. Like it's not a feedback. You have to base it all off of either ratios or chart patterns, like you're buying a pattern at a tip. But like when you get a 50x, that means that $1,000 turns into 50,000 bucks. A 10 grand position turns into $500,000. And what if you get a bunch of these things in your portfolio? So I don't think people, I mean, that's what woke me up to the strategy when I started implementing it. It's like, man, if I can get in early and you buy the ratio when it's cheap and the fears in the market, everything starts to click in the person's head. If you can just get one of them.
yeah.
Because then it's like once you get one or two returns like that, they're like, oh, now I know how it works. And now I know what the return is. And now I know what what it takes to get there. Like
Yeah.
the patience, how to buy it, and that strategy. It's incredible to get like a 30, 40, 50x. It is incredible. Especially if you've got like 10 or 20 grand in there, it's like, dude, that's life changing
Yeah.
on just one
Well, I
position.
haven't gotten a 30 or 50x yet. I do have a few. I do have some 10 baggers in my portfolio though. I bought a lot of uranium, not a lot, but a decent position back in May of 2020. So I was buying like Boss Energy and Bannerman at like pennies on the dollar at the time, and yeah, they're just sitting there. You know, they can go down 50%. I wouldn't bat an eye because I bought them in super cheap. That's I mean, that's the ultimate edge right there. Is just getting in super cheap, and position sizing accordingly. And you know, because essentially I don't do stop losses or any of that crap. I mean, some people might do it, but I just prefer to not go too overweight in my positions, and my position size is effectively my stop loss. So I can afford to lose 100% on a position. It's just another day. I can sleep soundly because it's not 100% of my allocation.
But even a 10 bagger is a huge, huge return.
Yeah.
And if you can get a couple of them in the
Yeah, because
portfolio, then
it's been ingrained in people's minds that just to passively invest, right, through ETFs and so forth. So, and most people don't think you can get a 10 bagger or a 30, 50 bagger unless you invest in crypto or some, you know, some stupid meme stock anyways. But I think, yeah. I mean, I just stick with a supply demand curve. And I tried to kind of explain like how spot works and how, you know, how these, you know, how these things, how the setup is like in moving out into the future. Like these pounds are just simply, it just doesn't really resonate with most people. So I just, you know what, just buy a little bit, watch it go up, and then when it does go up, you'll call me and you'll ask me like, oh, what else should I do? And then we can kind of get into it there because most people don't care unless they got significant skin in the game.
yeah. It becomes addicting if you get pretty good at it too. Like you won't want to spend money because you're like, oh, I can invest it all over here and 10x my money.
Yeah,
It
that's the way
becomes
I do
very
things. So
addictive.
it's like, should I really pay like, I don't know, like $800 or $900 for a new phone? I could take that $800 and invest it somewhere else and make $8,000. So if I take that $800 and put it on a new, you know, buy a new phone, then I've effectively lost $7,200 opportunity cost.
Yep. Yeah, I've done that for a while, but at some point I'm getting close to like, you know what, I've got enough invested. It's good.
Yeah,
Because if it
yeah.
does a
You got
10x
to
from here,
enjoy
it's
it.
like, yeah, I'm good. Yeah,
Yeah,
I might as
you
well.
want to be one of these guys like hoarding all this money into your 60s, and now you can't do
Warren
anything with
Buffett.
it. Yeah. But the thing with Warren Buffett though is that I'm sure if you would have, you can ask him like, would you give up all your money to go back to being 30 again? I'm sure he'd do it because like,
I would too.
yeah, because Warren Buffett knows how to make it back.
Yep.
But youth is more important than capital at the end of the day.
Yeah,
especially if you're like in your 20s. Like if you remember back in your 20s, like late teens as a guy, so many guys are willing to help you. So many people are willing to be your mentor, wanting to help you out. I'd say like once you hit like late 20s, it's like, what do you bring to the table? You lose that benefit of being like a young, a young up and coming guy. And now it's like in your 30s, like, okay, who the F are you? What do you bring to the table? If you don't do anything, get out of my sight. But back in your 20s, late teens, everyone's willing to help you. Like all these high profile, high profile people, and like these rich guys and so forth. They want to pass on what they know to a younger generation before they go. So they'll be more open to actually be mentor you if you're younger, as opposed to when you're middle aged and beyond.
Yeah, I noticed a large. I know this isn't related to uranium or whatever, but I noticed a large change when I hit like my late 20s, early 30s. Even how I interacted with my job, the W-2 and stuff.
Yeah.
That was kind of like the pivot point for me. So maybe that's what they're feeling.
Yeah, more people are willing to give
The
you the
mentors.
benefit of the doubt when like it's your first year or two of your career, when you're like 22, 23, 24. But it's like when you're 30, like either sink or swim, buddy. Like if you can't like provide any value here, then all right, peace.
What other sectors do you like out there? I know we talked a lot about uranium. Anything else that you like that
Yeah.
you're looking at currently?
Yeah, I'm looking at crypto. I made some. I've over the last two, I'd say the 2017 crypto bull market and the 2020 2021 crypto bull market, I made decent returns on both of those. So hoping to replicate that again. I'm not like a long-term hodler or anything. I typically just buy into crypto right before the big mania starts, and I try. It's pretty much my gambling exercise for the next 4 years. Is when that's pretty much the only time when I try to time markets. Um, but aside from uranium, I'd say again, coal looks pretty good. Looks like it's bottoming out. If you have some courage there, might be beneficial to sprinkle in some. Again,
Oh,
the gold
you've
miners look.
even used the word sprinkle. I like it.
Yeah. You know what? We need to get the salt meme. The guy in the white shirt.
Go like
You
this.
get the guy in the white shirt and just like crop in either your face or my face into that, and just like sprinkle in
Yeah.
some money into some gold miners. Um, yeah, I think. Well, I mean, you're still seeing these governments buy up more gold. These central banks buy up more gold. I read an article from Pravda the other day saying that as the Western countries continue to, or like the Western media continues to kind of vilify gold and downplay gold. Russia and China, these guys are continuing to gold because they understand the true value of gold. And I've heard conspiracy theories out there that maybe Bitcoin was, Bitcoin's a psyop. Don't crucify me for this. Bitcoin's a psyop to take away capital flow into gold, because there's a segment of people who would have invested in gold but are now investing in Bitcoin as a safe haven asset. And I have no way to prove this, obviously, but there are theories of that nature out there as well. But I think the gold miners look very undervalued. Crypto, I think, from if you want to gamble, that's a good gambling opportunity there. And but yeah, uranium is just a slam dunk at the moment, the way I see it.
So I'm gonna put you on the spot here. You got 100 grand to put money into companies today. How would you
Okay.
allocate that money?
Okay, 100 grand. So
Doesn't have to be perfect. You can do like
yeah,
10%, 20%, or just 50% here,
yeah. We're
or
not trying to
keep
get too
cash.
academic here. Yeah. So I'd look at my portfolio. So here's what I do. I'd look at my portfolio. I'd look at my my current percent allocation weighting in each given sector. Um, if I haven't looked at my portfolio in a month or two, so I don't know like what my percent weighting in uranium is at the moment, what my percent weighting is in gold miners is at the moment, et cetera. But depending on my percent weighting, if I'm underweight, so it has to satisfy a number of criteria. You know,
This is brand new portfolio, 100 grand.
oh, brand
Nothing to
new
do with your
portfolio.
current.
Okay.
Yep. Nothing to do with your current portfolio.
Okay. So, I pull up these ratio charts. I'd look at, I try to price uranium against oil like we just did. I try to price uranium against gold, gold against oil, copper against gold, etc. I think last time I checked, coal stocks looked really good. Um, I'd probably put, okay, here's what I do. I would do 20 20% uranium. I'd probably do 15% oil service companies. I think oil's cheap at the moment at $73. Probably like, coal at 15%. I'd probably be more weighted energy than I am precious metals. Uh, let's say 2-to-1 energy. 2-to-1 energy, 33%, just like copper, gold, silver miners, that kind of thing. And then the other 66% would be some sort of concoction of uranium miners, oil service companies, coal companies, nat gas companies. But I'd probably be, out of all of those, I'd be more overweight uranium at the moment, just because, I mean, this thing has the wind to
Momentum.
its sails. Wind to its sails.
Yep.
But I do like things like Petrobras. I do like a lot of these oil service companies, a lot of these coal companies that are just super cheap, paying high dividends. Why not?
I gotcha.
What about you? What would you do?
Well, I've made the most amount of money with what I think is the least amount of risk in oil and energy service. So that's where I'm overweight, and that's probably what I would overweight because I know it the best. Uranium has tons of upside. It's got all the wind at it, in its sails, like you said. The problem I have with uranium and the individual companies is I don't see it like a path for them to make cash flow.
Mm-hmm.
So that's my only hesitation with the uranium sector is how are these guys going to generate value for the shareholder?
Did they make cash flow in
And
2007?
what's that?
Did they make cash flow in 2007?
No, that's why they all fell back to
No, that's fine.
nothing.
I mean, we're not. I mean, again, we're not like investing
Agreed.
Coca-Cola for like 50 years.
Yeah, but I can buy, you can buy these oil companies at a price to earnings ratio of 1 or 2 or 3.
Mm-hmm.
Some of them pay a 10 to 20% dividend yield, depending on what you're looking at. And I think they've got every bit of upside almost as some of these uranium companies. So it's like, do I need to take the extra risk of no potential whatever? And, you know, maybe the timing, maybe uranium blows off first before oil and they can rotate money into oil. It's a possibility, but that's why I would allocate, to sectors like you did instead of just concentrating in one sector and hoping that that sector outperforms versus another. So I would do something very similar to you, and I would overweight energy and have a precious metals component to it.
Yeah.
So I'd probably put a good chunk in probably platinum or platinum miners, and then I would go into those are my favorite in the precious metals sectors. And then I would do a uranium allocation, maybe 20%. I'd probably put 30% in these big dividend payer like
Mm-hmm.
oil, nat gas. I'd probably put 20% in energy service. So that's 50, 60, 70% total. Probably put 10 to 20% in some of the mining companies with gold and silver.
Yeah.
Maybe even more, maybe Yeah, it'd be pretty even. Like a
Mhm.
like almost like 30, almost like a 25, almost, 25, 25, 25, 25 between those four sectors. Or 20, 20, 20, 20, and then 10% in something else like base metals and whatever else. It'd be
Yeah.
something similar to that.
Yeah. Yeah. I mean, I'd probably put a little bit more in uranium just because it has that early
Which is
short-term
fine.
momentum. Yeah.
Which is
And
fine.
plus, it also depends on your situation too. Like, um, if you do have a W-2 job, if you do have a business that you're getting income from, maybe you may not need that at, those dividend. You may not take the dividend approach as much. But if you're kind of like your own, if you're looking to generate capital off of, if you don't have that extra income flow coming from something external, then you might want to go more dividends essentially. Yeah. So it depends individually on the person as well. So I mean, I have income flow coming in from external sources, so I may not be as overweight on the dividend side. I mean, because I may be prioritizing growth as opposed to getting paid every month or getting paid every what is it, 6 months or a year.
The one thing I'll say is some of these dividend payers, I think there's a ton of growth with them too on some of them.
Mm, yeah,
So I think you get your
get the
cake
best of both
and you
worlds.
get to eat everything and it's all there.
Yeah.
And it's undervalued. And if the price goes up, your dividends will explode. So there's some companies that they're increasing production 50% over the next, 2020s. Some are doubling production of oil and they're paying 11% dividend yield. It's like, whew, that's good.
What else do
I'll
you
take
want?
it.
What more do you
I'll
want?
take it all. I'll take it. Some of these Canadian companies.
Yeah, yeah. I mean,
What
I do
about,
have a dividend. I do have a dividend portion of my portfolio, but it's I just may try to focus on growth.
Mhm.
That's just my style.
I like the dividends. I do. It's like cheating.
Yeah.
They're making cash too. Um, what about like tax accounts? Like the accounts that you put money into. Do you use like a Roth 401k, Roth IRA? A lot of people always ask me questions about, how to, where should they put money? And I'm not saying that this is advice or anything like that, but how did you allocate? I try to put everything I can in a Roth or a Roth 401k, one of those IRA or 401k, depending on what's available to you. Do you take advantage of those things too, or?
Yeah, I have a Roth 401k. I try to, but it's not like I'm not relying on it to retire me, but it's, whatever capital, whatever money I can put in there, it's just free money. So it's just, why not?
Yeah, yeah, and
I'm
the
not like,
difference for
it's not like a
everybody.
big part of my strategy to get rich, but it's just, I'll take the free money. Sure.
So just so people kind of, if you're younger, just to let you know, as you become more wealthy, as you get more income from dividends and your account values go way up, there is a time where you'll shift into figuring out how to keep your money because taxes become a really big deal.
Mm-hmm.
So I try to I put a lot in Roth IRAs, Roth 401ks when my tax levels were lower. And as you start to make more money, as you have more dividend income and stuff like that, it becomes very important. And taxes become a huge deal. So you're always looking at how can you keep your money versus just giving it away. And qualified dividends are at a lower tax. It's 15%. Capital gains tax, depending on your holding period, it can be different.
Yeah.
And all of that matters, in my opinion. And
Yeah.
and some of the big positions that I have, I'm reluctant to sell it because there's so much gains in it. And
Crazy
I know it's
taxable event.
15% because it's
Yeah.
long-term capital gains, but I don't want to pay the tax necessarily
And hey, that's
in
another
some of
thing
these years.
that goes back to being patient and just holding through volatility and not getting too overwhelmed with analysis paralysis from all of these different media sources, right? Because what they're going to end up doing to you is that they're they're going to make you take actions in one way, shape, or form. And the longer you can go without selling, not financial advice. That's just it's my style. I've been holding these commodity companies for about 4 years now almost. And one of the big reasons behind that is that I just don't want to create that taxable event. If I like try to like get too cute with this stuff and say, oh, well, XYZ is outperforming ABC, uranium's outperforming oil stocks. So what if I sell my oil stock to buy uranium, and then I sell my uranium and go back and buy oil at a later time? Well, hold on a second. 33% taxable event here, 33% taxable event here. And I may not even get it right. I may not even get it right on top of that. I just prefer to, kind of, sometimes you just got to dumb yourself down a bit. I hate to say it, but you can't overthink this stuff. And, a lot of people, they try to make this stuff rocket science, which is, fine. But again, sometimes less is more, and just figure out a strategy and stick to the strategy.
And what is that strategy? Long term? Buy when it's cheap, hold on.
To me, it's long term. I mean, I just follow what these old guys say. It's just say, oh well, I just find a bag of money and I go up there and I pick it up.
Jim Rogers.
Yeah. But yeah, my strategy is to just be patient. If you look at average holding period of a stock over time, it went from like 10 years in 1950. Now it's down to like 7 months today. So most people are very anxious. I need to do something. We need to do something. Well, sometimes doing something, sometimes doing something can actually be counterproductive. Yes. Right? Doing nothing is preferable to being counterproductive. So in my mind, one way I can get an edge relative to everyone else is just to be a little bit more patient than everyone else. And I don't know, it's worked out so far. And there's another mistake is people get married to these stocks. People get married to this sector. They start identifying themselves as like, I'm a uranium bull. I love uranium. Like, I love uranium too. I love nuclear. It's the way of the future. But like, I'm going to sell these things eventually. And there's going to come a time where we part ways and I'm going to take my profits. At the end of the day, we all came into this trade, for big gains. And it's another problem is that people begin to get emotionally attached to these stocks, get emotionally attached to the sector. I'm not just like honing in on uranium. That's just one example. Crypto, same thing. Crypto.
So
got to be as agnostic
would you say if you're getting married to it, eventually you're going to end up in a heartbreak and a 50% loss?
Yeah.
With the divorce.
Hey, you could slice it whichever way you want. Before you get married to it, be sure to sign that prenup.
Yeah. You don't want a 50% loss as you write it down.
Yep.
Yeah. So anything else that you'd like to share with members or anything like that?
No. Well, I do have, let's see, do I have it up? No, I don't have it up. Give me like, I want to show you this uranium chart really quick.
Okay.
Yeah, so I did a podcast with Thomas George the other day. He showed off this really cool chart. I think your audience would enjoy it. Here it is. Okay. So basically what you've got here on the left-hand side, you've got the uranium bull market from 2003 to 2007. You've got the blue line here, which tells you your this denotes the average performance or the performance of the bottom 50th percentile of market caps stocks, or bottom 50% of uranium stocks by market cap. So these are like your shitcos all the way up to your mid caps, right? The blue line, that's the blue line. Now the yellow line is your Cameco performance. And what you'll notice here is that Cameco overperforms the shitcos to the mid caps up until the very end. So the bottom 50th percentile lags behind the majors like Cameco for quite some time, all the way up until right before the finish line, and then it just skyrocket. Mm-hmm. The right hand, the chart on the right side, this only goes to September of 2023, but so it's basically, we're seeing Cameco outperforming the bottom 50th percentile by a significant margin as well. So these, you can say that Cameco's at near all-time highs, which is fine, but just keep in mind, once that's probably another sell side indicator for you as well, is that when you start seeing some of these small caps and mid cap stocks begin to outperform the majors by a significant degree, that's probably a sign of a top. You kind of saw that on a micro scale here in 2021, right? Mm-hmm. When the blue line got over the yellow line. Anytime that happens is probably what I'd look at, reconsidering the trade. But as of right now, I mean, we're still significantly undervalued relative to Cameco.
So just looking at that chart in 2021, when the blue line went over the Cameco line, that looks almost exactly the same, the fractal and the way it looks, as July of 2023, like just past that. It's like the same looking fractal. And it went over Cameco just like it did in the beginning in 2003. If you look at the one on the left, see the beginning fractal where the blue line went over the yellow line. Yeah, in the beginning, and look at this. It's the same type of movement too.
Yep.
It looks almost like a mini head and shoulders.
Exactly. So
so right now you could say that maybe we're like in 2005 or 4 or 5 or something. That large divergence.
So you're like right
between
here. So you still got a few years to go. Yeah, that's a good point actually. So I mean, here the blue line was probably 150% from the starting point, right?
Mm-hmm.
Right. The blue line here is at 300%.
It's a bigger fractal, more upside.
Yeah, way more. So it's twice the upside essentially.
Yes. Yep. Twice the upside as 2007 potentially, if that holds true.
Yeah, of course. So yeah, I think this is a good chart to kind of figure out where we're at currently. Because you always get the question like, oh, what inning are we in? What inning are we in? This kind of tells you, you're probably, like you kind of alluded to there, we're about halfway there, probably 5th inning. But keep in mind, all the home runs and grand slams are hit in the ninth inning.
Yeah, it's a good closer. Hit the grand slams on the closer.
Yep. Yeah, this thing just, you think it's out, and then boom, just shoots up here in 2007. Goes up.
That would be a good
dealing with a 12x collectively.
It's a good ratio. Good time to use a ratio chart.
Mm-hmm.
Because that's really what we're showing. That's cool.
Yeah.
All right. So we can end it there. How do people follow you? How do they reach out to you? How do they contact you? How do they do that?
Yeah. So I am at CapitalCOSM on YouTube. We cover a lot of the same stuff that Andy does. We look at technical charts, technical analysis, charting. We also interview experts. We do live streams, try to answer your questions in the chat as well. You can also find me on X at CapitalCOSM. And thanks for having me on, Andy. It's an honor to be interviewed by you. I've been watching your channel for damn near 3 years now, and so it's pretty cool to see me a part of it now.
Yeah, thanks for coming on. Really appreciate it and spending the time. And sometimes I like, bringing on rising stars like yourself, Danny. So thanks for coming on and sharing your opinions.
Well, thanks, Andy. It's a pleasure. And hopefully we can do it again someday. I'll have you on my channel as well soon.
Yeah, definitely. And see you, everyone. Thanks for attending, and put down Go CapitalCOSM in the comments section.